In 1923, a Chinese laundryman in San Francisco named Li Kuang started washing shirts for 12 cents each. Every laundry in the city was owned by someone like him, a man America refused to hire for any other job. When Li died in 1941, his family owned 4 buildings outright. Nobody outside the neighborhood knew. The method he used is number 11 on this list, and it required nothing but a tub, soap, and a willingness to do the work nobody else wanted. Number 7 was used by Italian and Jewish families to turn worthless buildings in neighborhoods nobody wanted into the foundation of generational wealth. And number 1 built more lasting prosperity in immigrant communities than any bank that would actually loan them money. These were not secrets, they were survival strategies. The kind of thing passed down in kitchens and back rooms because nobody was going to teach them in school. Before we start, hit subscribe because what you're about to see will surprise you. Number 21, the rotating credit circle. Before any immigrant community had access to an American bank, they built their own. The method had different names depending on where you came from. Korean immigrants called it a jai. Chinese communities called it a hui. Italian families in South Philadelphia called it simply the circle. Jewish immigrants on the Lower East Side built mutual aid societies that included interest-free loan funds specifically designed to give members access to capital no American institution would extend to them. The mechanics were identical everywhere. 10 families each put in $5 a week. Every week, one family took the entire pot, $50, which in 1910 represented roughly 2 weeks of factory wages for a man willing to work 12-hour shifts. Each family got their turn. No interest, no paperwork, no bank that could say no. By the time a family had contributed their 10 weeks and received their one payout, they had access to capital that no institution in America would extend to them. They used it to open a laundry, a grocery, a tailor shop, a pushcart business. The next family did the same. The Lower East Side of Manhattan by 1910 had one of the most extraordinary concentrations of small business ownership in any American city. Economists at the time called it an anomaly. They could not figure out where the capital was coming from. It was coming from kitchens on Friday nights, from envelopes passed between neighbors, from a financial system that required nothing but trust and a shared understanding that the only way out was together. The rotating credit circle still operates in immigrant communities across America today. Koreans in Los Angeles, Ethiopians in Washington, D.C., Vietnamese families in Houston. The amounts are larger. The principle has not changed in 100 years. If you're enjoying this content, subscribe now. Number 20, the pushcart economy. In 1905, a newly arrived Italian immigrant named Antonio Caruso pays $2 to rent a pushcart on Mulberry Street in Lower Manhattan. He fills it with produce he buys at 4 in the morning from the Washington Market wholesale docks before the retail grocers arrive. He marks it up 30% and sells out by noon. 6 days a week, 50 weeks a year, Antonio clears more money than the men who work 12 hours a day in the garment factories nearby. The pushcart was not a step down, it was the only door open. Over the decades that followed, more than 25,000 pushcart vendors would operate in New York City alone, the Lower East Side, Chicago's Maxwell Street, and immigrant neighborhoods in every major American city filled with these mobile operations, each one run by a family that had been told no by every formal employer in reach. City licensing laws required pushcart operators to be citizens or have a sponsor, which most immigrants could not get. So communities developed informal systems where an established family member held the license and newer arrivals operated under it, splitting the profits. The city called it a violation. The families called it getting started. The pushcart formed the distribution backbone of entire immigrant neighborhoods, moving fresh food, dry goods, clothing, and household items to communities that American retail chains had no interest in serving. The modern equivalent is the food truck the Etsy shop, the Amazon seller account, a low-cost entry point into commerce that requires hustle and early mornings and nothing else. The math is identical. The cart is just digital now. Number 19, taking in boarders. An Irish woman arrives in Pittsburgh in 1899 with children and no husband. She cannot get factory work because the factories do not hire women for anything but the lowest paid textile positions, and those pay less than it costs to feed her children. She takes in boarders. 2 men from her village back home are already in Pittsburgh working in the steel mills. They need somewhere to sleep, somewhere to eat a meal that tastes like home, somewhere a man can speak his own language after 10 hours of dangerous work. She charges them $3 a week each, which includes a bed, 2 meals a day, and laundry, $6 a week coming in. Her rent is $4 a month. This is not an unusual story. Census data from 1900 shows that nearly 1 in 5 immigrant households in industrial American cities had at least one paying boarder under the roof. In some Polish and Slovak neighborhoods in Pennsylvania, the rate was closer to 1 in 3. Women who could not access wages ran what were effectively small hotels out of their homes, and they did it without a business license, without a bank account, and without anyone counting it as income. The modern equivalent is Airbnb. The average American host earns thousands of dollars a year renting out spare space. These women understood the business model 100 years before the app existed. In 1912, a Greek immigrant named Stavros Pappas opens a grocery on the south side of Chicago, in a neighborhood where almost everyone speaks Greek, eats Greek food, and cannot find the ingredients they need at American stores. Stavros does not compete with American grocery chains. He serves a market the chains have decided does not exist. He buys olive oil, dried beans, olives, and preserved fish directly from Greek importers at wholesale prices. He sells them at retail to his neighbors. His margins are higher than an American grocer because he has no competition within his community. His customers are more loyal because he is the only source for what they need. And because he extends credit to families he knows personally, his community cannot afford to shop anywhere else even if they wanted to. By 1920, ethnic grocery networks run by Greek, Italian, Jewish, Chinese, and Polish operators supply entire urban neighborhoods with food that American wholesale and retail systems have no infrastructure to deliver. These stores are not charity. They are precision-targeted businesses serving underserved markets at healthy margins. The modern equivalent is every niche food retailer, specialty importer, and ethnic supermarket chain operating today. The insight has not changed. Find the customer nobody else is serving and serve them better than anyone else ever will. In 1907, the tenements of Mott Street in Lower Manhattan operate as a second garment industry that official records barely acknowledge. Italian women sit at kitchen tables sewing buttonholes, hemming collars, attaching buttons, and assembling artificial flowers, all paid by the piece, not by the hour. Their children sort materials. Their husbands press and fold in the evenings after factory shifts. The apartment becomes a small factory. The piecework model rewards speed and focus in ways that hourly wages never do. A worker who controls her own pace controls her own income. And in a community where formal employment is either unavailable or pays poverty wages, piecework represents something radical: the ability to increase your earnings through your own effort rather than an employer's decision. The Bureau of Labor Statistics documented this home manufacturing economy extensively in the early 1900s, estimating it contributed tens of millions of dollars annually to New York City's garment economy, an economy that officially employed only the workers it could see in factories and lofts. The modern equivalent is every freelancer, every gig worker, every Upwork contractor who gets paid per deliverable rather than per hour. The unit rate model has not changed in 100 years. The tenement has just been replaced by a laptop. Number 16. the Community Garden Cooperative. In 1918, a block of Polish immigrant families in Milwaukee converted a vacant lot behind their building into a shared vegetable garden. They divided the plot into sections, each family responsible for one crop. One family grew potatoes, one grew cabbage, one grew carrots and beets. At harvest, they shared everything in proportion to what they contributed. No money changed hands, no store took a margin. A family of 5 growing their own vegetables in a well-managed plot in 1920 saved the equivalent of $30 to $40 a year in grocery costs. If you're enjoying this content, subscribe now. At a time when the average Polish factory worker in Milwaukee earned less than $600 a year, $30 to $40 represented nearly a full week of wages recovered through dirt and labor. The community aspect of the cooperative multiplied the benefit. When one family's crop failed, the others covered the gap. When one family had surplus, it circulated rather than rotted. The system built the kind of resilience that individual families could not build alone, and it did so without any institution's permission or involvement. The modern equivalent is the community garden movement, the food cooperative, the neighborhood buying club. The math has not changed. The vacant lot is just harder to find now. In 1882, the United States passed the Chinese Exclusion Act, the first and only federal law to bar an entire ethnic group from immigrating. The law did not stop there. In San Francisco, city ordinances required laundry operators in wooden buildings to obtain permits. Of the roughly 320 laundries operating in wooden buildings at the time, about 2/3 were owned by Chinese operators. When they applied for permits to continue operating, only one was granted. Non-Chinese applicants were approved almost without exception. The message was not subtle. Chinese men in San Francisco were legally barred from most employment, denied permits to run the businesses they had already built, and told through policy and violence that the city did not want them here. What they did instead defined the next 50 years of Chinese-American economic history. They took the work nobody else wanted, washing other people's clothes, and they built it into the dominant laundry industry in every major American city. By the early 20th century, Chinese-owned laundries operated from coast to coast, not because Chinese men had any particular affinity for laundry work, but because exclusion had eliminated every other option, and laundry had 2 qualities nothing else could offer. It required no English and no employer willing to hire them. The lesson was not about laundry, it was about finding the work that is essential, unglamorous, and abandoned by everyone with other options. That work always pays, it always has. Pattern break. The first 7 entries on this list share one characteristic. They are about surviving inside a system designed to exclude you, taking the lowest rung and turning it into something. Building capital from nothing, because nothing was all that was being offered. The next section is different. This is where immigrant communities stopped surviving and started building. And the methods they used were not desperate, they were precise. Number 14, the ethnic trade monopoly. By 1895, Italian immigrants controlled the fresh fruit and vegetable wholesale trade in New York City so completely that virtually no produce enters the city's retail market without passing through Italian hands at some point in the chain. This does not happen by accident. It happens because of a deliberate and coordinated strategy that takes roughly 15 years to execute. It starts with the pushcart. An Italian vendor on a street corner in 1880 is just a man selling fruit, but that man knows every other Italian vendor on every other corner. They share information about where to buy cheapest, when supply is short, and which wholesalers cheat on weight. Over time, that information network becomes a procurement network. The procurement network becomes a wholesale operation. The wholesale operation becomes the infrastructure through which an entire city feeds itself. When American wholesale operators try to compete, they find that the Italian network has relationships, credit systems, and supply chains that took a generation to build and cannot be replicated by an outsider in any reasonable time frame. The ethnic trade monopoly is not a conspiracy, It is the natural outcome of a community that shares information and capital while the surrounding society shares neither with them. The same pattern plays out with Chinese laundries, Jewish garment manufacturers, Greek restaurant suppliers, and Korean grocers. Every ethnic trade monopoly in American history follows the same arc. Exclusion forces concentration. Concentration creates efficiency. Efficiency creates dominance. The modern equivalent is every industry cluster, like Silicon Valley, Hollywood, and Wall Street, where a dense network of shared relationships and information produces outcomes no individual actor could achieve alone. If you're enjoying this content, subscribe now. Number 13, the informal loan system. In 1925, a Jewish immigrant named Hyman Rosen wants to open a second dry goods store on Delancey Street in Lower Manhattan. He goes to 3 American banks, and all 3 decline. He has no credit history in America, no collateral they recognize, and an accent that makes the loan officers uncomfortable. What Hyman has instead is a reputation inside his own community. He goes to 6 men he has known for 10 years, men who have watched him run his first store, pay his debts, and treat his customers honestly. Each man lends him $200, no interest, no written contract, no legal recourse if Hyman defaults. The entire transaction runs on reputation, and the understanding is this: a man who fails to repay a community loan does not simply lose money. He loses the only financial network available to him. Hyman opens a second store. Within 3 years, he repays every lender. Each of those 6 men now has a standing relationship with a successful borrower who owes them a favor. That favor is worth more than any interest rate. The informal loan system operates on social collateral rather than financial collateral. It works precisely because the stakes of default are higher than any bank can impose. A bank can take your property, a community can take your place in it. The modern equivalent is peer-to-peer lending, community development financial institutions, and the informal networks through which small business capital still flows in communities that banks continue to underserve. Number 12, the language premium. In 1910, an Eastern European Jewish immigrant named Samuel Goldberg speaks English, Yiddish, Russian, and Polish fluently. Every factory owner on the Lower East Side needs someone who can communicate with the workforce. Every new arrival needs someone who can navigate city bureaucracy, write letters, translate documents, and explain contracts they cannot read. Samuel charges for all of it: 25 cents to translate a letter, 50 cents to accompany a family to the immigration office and translate their answers to the inspector's questions, $1 to review an employment contract and explain what it actually says, $2 to write a formal letter to a government agency on behalf of a family who cannot write in English. This is not a side business. This is Samuel's primary income, and it earns him more than most factory workers make in the same hours. He is selling a skill the market desperately needs and almost nobody inside his community possesses. The language premium is simply the application of supply and demand to a resource that immigration had made scarce. By 1920, every immigrant community of any size has its own class of language brokers, men and women who earn a living translating not just words but systems, processes, and institutions for people navigating them for the first time. The service is essential, and the market for it never disappears. The modern equivalent is every interpreter, every immigration consultant, every professional who earns a premium for bridging 2 worlds that cannot communicate directly. The language has changed, the premium has not. Number 11. The pushcart to storefront pipeline. Antonio Caruso, the Italian fruit vendor from Mulberry Street, does not stay on the pushcart. That was never the plan. The pushcart is where you accumulate the capital, learn the customers, identify the gaps, and build the reputation that makes the next step possible. The storefront is the destination. In 1905, Antonio is selling from a cart. By 1909, he has saved enough from 4 years of 6-day weeks to put down the first month's rent on a small storefront 3 blocks away. He already knows every customer in the neighborhood. They already trust his produce. The transition from cart to store costs him almost nothing in marketing because the marketing has been happening every morning for 4 years from a moving vehicle. The push cart to storefront pipeline is the immigrant version of the startup to business model. The push cart is the minimum viable product, low cost, low risk, direct customer feedback every single day. The storefront is the scale up, funded by the cash flow the cart generated and de-risked by the market knowledge the cart provided. Between 1880 and 1920, the majority of immigrant-owned small businesses in American cities traced their origin to a push cart, a market stall, or a street corner operation. The capital required to open a storefront in 1905 is roughly $200. A disciplined pushcart operator saves that in less than 2 years. The modern equivalent is every online seller who opens a physical location, every food truck operator who opens a restaurant, every freelancer who turns their practice into an agency. The pipeline has not changed. The cart is just a different shape now. In 1903, a Sicilian laborer named Giuseppe Marino works construction in New York City 6 days a week and sends half his wages home to his family in Palermo every month. This is not generosity. This is a calculated financial strategy that most American economists of the time completely misread. What Giuseppe understands and what the economists miss is that a dollar sent to Sicily in 1903 does not buy $1 worth of goods. It buys 4. The exchange rate combined with the drastically lower cost of living in rural Sicily means that $20 a month from New York becomes the equivalent of $80 of purchasing power on the ground in Palermo. His family back home is not just surviving. They are accumulating land, paying off debts, and building a house on remittances from a construction laborer earning subsistence wages in America. Meanwhile, Giuseppe himself is not spending what remains. He lives in a boarding house with 7 other men from his village, splitting the rent 8 ways. He eats the cheapest food available. He has no expenses that are not strictly necessary. Every dollar he does not send home accumulates in a tin box under his mattress, building toward the one goal that makes everything else make sense. He is going back. Most early 20th century Italian, Greek, and Eastern European immigrants do not intend to stay in America permanently. They intend to earn American wages, exploit the exchange rate differential, accumulate capital, and return home transformed. According to historian Thomas Archdeacon, 46% of Italians who entered the United States between 1899 and 1924 permanently returned home. Between 1900 and 1914, Italian immigrants sent hundreds of millions of dollars back to Italy annually, a flow of capital so significant that the Italian government tracked it, the American government worried about it, and American banks eventually built entire wire transfer businesses to capture a fee from it. The strategy requires brutal discipline and the willingness to live far below your means for years. The men who execute it successfully return home with enough capital to buy land, start businesses, and establish their families in a comfort that would have been impossible without the American years. The ones who stay in America and build here use the same discipline for different ends. Either way, the engine is identical. Earn in a strong currency, spend in a weak one, and never confuse the two. The modern equivalent is every immigrant worker in America who sends money home to a country with a favorable exchange rate. Every digital nomad earning in dollars while living in a cheaper economy. Every remote worker who relocates to reduce their cost of living while keeping their American salary. The arbitrage has not changed. The tin box under the mattress is just a wise account now. In 1895, the Jewish community on Hester Street in Lower Manhattan established what amounted to a permanent outdoor market. It operated every day of the week except Saturday, when observant families rested. The market was not organized by any institution. It grew organically from the simple fact that when enough vendors operated in the same place on the same schedule, buyers knew where to find them. Fixed location, fixed schedule, repeat customers. These three elements are the foundation of every successful retail operation that has ever existed, and immigrant street market operators understood them intuitively in ways that formal retail theory would not articulate for another 50 years. A vendor who showed up in the same place at the same time every day built something that random street selling never produced, a customer base that did not need to be found because it knew where to find you. The Italian fruit vendor at the corner of Mulberry and Grand every morning between 7 and noon was not just selling fruit. He was building a route, a relationship, and a reputation that compounded with every transaction. By 1900, immigrant neighborhood markets in New York, Chicago, and Philadelphia operated as sophisticated commercial ecosystems with established price discovery, credit relationships between vendors and regular customers, and informal quality standards that no city inspector enforced but every customer enforced through their feet. The market self-regulated because its participants could not afford for it to fail. The modern equivalent is every farmer's market, every pop-up, every vendor who builds a loyal customer base through consistent presence at a fixed location. The format is thousands of years old. Immigrant communities brought it to American cities at a moment when formal retail had not yet figured out how to serve them, and they built businesses from it that lasted generations. In 1910, a Polish barber named Wojciech Kaminski runs a two-chair shop on the north side of Chicago. He is skilled and his shop is full. But the most profitable thing he does is not cutting hair. It is teaching men from his community how to cut hair so they can open their own shops. He charges $5 for a month of evening instruction, a significant sum for a laborer earning $8 or $9 a week, but a fraction of the cost of the formal barbering schools in the city, schools that refuse Polish students. For $5, a new arrival learns a licensed trade. For Wojciech, $5 a month per student with 6 students is $30 a month in income that requires no extra overhead, no supplies, and no additional hours during the business day. Informal trade schools appear inside immigrant communities wherever formal education and licensing systems exclude new arrivals. Italian shoemakers teach shoemaking. Jewish tailors teach tailoring. Chinese laundrymen teach the mechanics of the trade to new arrivals who need a livelihood immediately. Knowledge passes through the community in exchange for small payments that add up to meaningful supplemental income for the teacher. The system serves both parties. The teacher earns income from knowledge he already possesses. The student acquires a marketable skill at a fraction of the cost the formal market would charge. The community builds a supply of trained workers in trades it already controls, deepening the ethnic trade monopoly one apprentice at a time. The modern equivalent is every online course creator, every skills trainer, every professional who packages their expertise into instruction and sells it to people earlier in the same journey. The format has not changed. The classroom is now digital. Pattern break. Every method on this list so far has one thing in common. It starts from nothing and builds towards something. The rotating credit circle starts with $5 a week. The pushcart starts with $2 for a day's rental. The language premium starts with the accident of being multilingual in a monolingual environment. What follows is different. These are not methods for getting started. These are methods for converting what you have built into something that lasts beyond you. This is where immigrant communities stopped thinking about survival and started thinking about legacy. Number 7, buying property nobody wanted. In 1905, a Jewish real estate operator named Abraham Kaplan pays $600 for a tenement building on Orchard Street in Lower Manhattan. The building is deteriorating. The neighborhood is overcrowded. American investors have no interest in it. $600 is roughly 3 months of skilled factory wages, not a trivial sum, but accessible to a man who has spent 5 years saving systematically. Abraham does not renovate the building, he does not upgrade it. He collects the rent from the 12 families already living in it, and he holds it. By 1920, the neighborhood that American investors considered a slum has become the commercial heart of the most densely populated Jewish community in the world. The building Abraham bought for $600 is now worth several thousand. He sells it and buys 3 more in a neighborhood that is just beginning to densify with the next wave of immigrants. The pattern repeats across every immigrant community and every American city where institutional exclusion has concentrated poverty into specific neighborhoods. Italian immigrants buy in Little Italy. Chinese families buy in Chinatown. Polish families buy in their neighborhoods on the south side of Chicago. The buildings are cheap because the neighborhoods are poor. The neighborhoods are poor because institutional exclusion has concentrated immigrants with no capital into them. But exclusion also concentrates community, and community creates demand for housing, retail, and services that makes property in those neighborhoods appreciate steadily as the community grows. The immigrant property buyer in 1905 is not speculating. He is buying into the only market that will sell to him and betting that his own community will make that market more valuable over time. He is almost always right. The modern equivalent is every investor who buys in an undervalued neighborhood before it gentrifies. Every entrepreneur who enters a market before institutional money discovers it. The insight is identical. The opportunity is always where nobody else is looking yet. In 1886, a group of Italian immigrants in New York City formalized what had been an informal practice among their community for years. They established a mutual aid society with written bylaws, elected officers, and a dues structure. Members paid 50 cents a month. In exchange, they received sick benefits when they could not work, a death benefit paid to their families, access to a community doctor who treated members at reduced rates, and loans from the society's accumulated funds at 0 interest. What this society built, without using any of those terms, was a health insurance system, a life insurance system, a community bank, and a social safety net, all operating outside any American institution and funded entirely by the community it served. By 1910, there were thousands of such societies operating across immigrant communities in American cities. Italian mutual aid societies, Greek beneficial societies, Jewish Landsmannschaften, Polish fraternal orders. Each one was a parallel and social infrastructure built by people who had been excluded from the American versions of the same institutions. The critical financial function of these societies was the loan. A member who needed capital to open a business, buy property, or weather a crisis could borrow from the society's fund at 0 interest with community members as guarantors. The same social collateral that made informal loans work. The knowledge that default meant losing your place in the community made mutual aid society loans repay at rates that commercial banks could not match. The societies also accumulated capital over time. Dues collected from hundreds of members, invested conservatively and loaned carefully, built into funds that could underwrite significant community projects, churches, schools, and community centers that no American institution was willing to fund. The modern equivalent is the credit union, the cooperative, the community development financial institution. The structure has been formalized and regulated. The principle has not changed since 1886. Number 5, keeping 2 sets of books. In the early 20th century, many immigrant-owned small businesses in American cities operated what owners understood as 2 economies at once. The first economy was the one on paper, the sales recorded in the ledger, the income reported to the landlord who set rent based on declared revenue, and the numbers shown to inspectors and licensing authorities. The second economy was the one that actually happened, the cash transactions that never entered the ledger, the income that stayed in the tin box, the financial reality of the business as its owner understood it. This was not unique to immigrants. American small business cash economy practices in the early 20th century were widespread across all communities. But for immigrant business owners who faced discriminatory licensing, inflated rents charged because landlords knew their tenants had no legal recourse, and tax systems they did not fully understand and could not navigate without paid help, the cash economy represented something additional, a hedge against a system that had demonstrated it could not be trusted to treat them fairly. The practical effect was that immigrant business owners frequently accumulated capital faster than their official records suggested was possible. The money did not go to consumption, it went to property, to the rotating credit circle, to the mutual aid society fund, and to the education of children. It built quietly and invisibly in communities that the surrounding economy had decided were not worth paying attention to. Number 4, the marriage of trades. In 1908, a Jewish tailor named Morris Feldman marries the daughter of a fabric importer named Isaac Weiss. This is not a coincidence. Within immigrant communities that concentrate around specific trades, the marriage of complementary skills is a recognized and deliberate wealth-building strategy. Morris has the production capacity, a shop, trained workers, and clients. Isaac has the supply chain, direct relationships with fabric manufacturers in Europe, and the ability to buy wholesale and sell to the trade. Together, they eliminate the middleman that has been taking a margin from both of them. Morris gets fabric at cost. Isaac gets a guaranteed buyer for his inventory. The combined business earns margins that neither could achieve independently. The same pattern appears across every immigrant trade community. An Italian fruit wholesaler marries his daughter to a produce retailer, consolidating the supply chain from dock to customer. A Chinese laundry operator whose son marries into a family that manufactures laundry equipment captures the equipment supply that has been a recurring cost. A Greek restaurant owner whose daughter marries an olive oil importer eliminates his largest food cost. These are not romantic arrangements made for financial reasons. They are business arrangements that happen to involve romance. More precisely, they reflect communities where business relationships and family relationships are not kept separate, because keeping them separate is a luxury of people who have access to formal markets. Inside communities excluded from those markets, family is the market. The modern equivalent is the strategic partnership, the joint venture, the vertical integration play. The logic is identical. Control more of the chain and keep more of the margin. Number 3, building what you cannot be hired to do. Salvatore Ferragamo was born in 1898 in Veneto, a small farming village in southern Italy. He was the 11th of 14 children. Ferragamo had been making shoes since he was 9 years old, first for his sister's confirmation, then for everyone in the village who would let him practice. He understood foot anatomy in a way that formally trained shoemakers did not. He understood the relationship between the shape of a last and the comfort of the finished shoe in a way he could not explain but could demonstrate in every pair he made. In 1915, at age 16, Ferragamo moved to America, first to Boston, then drawn by the film industry to California. America did not welcome him into its factories. American shoe factories would not hire him. He was Italian, he was young, he spoke limited English, and the factories were not looking for someone with his specific kind of knowledge, the kind that comes from obsessive practice rather than formal training. So he opened his own repair and custom shoe shop in Santa Barbara, serving actors working at the nearby film studios. By 1923, he purchased a Hollywood boot shop on Hollywood Boulevard. By 1927, his clients included Mary Pickford, Gloria Swanson, Joan Crawford, and Rudolph Valentino. Hollywood became his proving ground. Ferragamo did not succeed despite being excluded from the formal shoe industry. He succeeded partly because of it. Exclusion forced him to build his own customer base, his own reputation, and his own standards rather than adopting those of an employer who would have constrained him. The rejection letter became the business plan. This is the pattern across every immigrant entrepreneur who builds something significant. the door is closed. They build a different door. And because they build it themselves from their own materials, by their own standards, they own it completely. Number 2, educating the next generation as the primary investment. In 1915, a Jewish couple named Samuel and Esther Horowitz live in a 2-room apartment on the Lower East Side. Samuel works 12 hours a day in a garment factory. Esther takes in piecework. Together, they earn enough to survive and a little more. The little more does not go to a larger apartment. It does not go to better furniture or nicer clothes or any of the visible signals of prosperity that their American-born neighbors increasingly pursue. It goes to their son's education. By 1925, their son David is enrolled at City College of New York, one of the few institutions of higher education that charges no tuition and admits students on academic merit regardless of religion or national origin. By 1932, he is a licensed attorney. By 1940, he earns in a year what his father earned in a decade. The investment thesis that Samuel and Esther operate on is simple, and it is exactly correct. Property can be seized, savings can be inflated away, a trade can be regulated out of existence, but a credential, a degree, a license, a professional qualification is portable, durable, and compounds in value over a lifetime in ways that almost no other asset can match. Immigrant communities that prioritize education above consumption do not see results in one generation. They see them in 2, reliably, across every ethnic community that follows this pattern consistently. The Jewish community executes this strategy most systematically and most visibly in the early 20th century. The same pattern appears in every immigrant community that builds lasting wealth. Italian families sending sons to night school, Greek families funding college through restaurant earnings, Chinese families working laundries so their children can become engineers and doctors. The asset is always the child. The return on that investment compounds for the rest of the family's history. Number 1, owning the building your business operates in. This is the destination every other method on this list points toward. Not a larger apartment, not a fancier shop, not more inventory. The building itself, owned outright, permanently. In 1920, a Chinese laundry operator in San Francisco named Wei Chen had been washing shirts in the same location for 18 years. For 18 years, he had paid rent to a landlord who could raise that rent, sell the building, or refuse to renew the lease at any moment. The laundry's location is his most valuable asset, 18 years of customers who know where to find it, and that asset belongs to the landlord, not to Wei. In 1920, Wei bought the building. He did not do this through an American bank, which would not lend to him. He did it through the HUE, the rotating credit circle his community had operated since before he arrived in San Francisco, combined with loans from the Chinese Mutual Aid Society, and with 18 years of cash savings built by the discipline of a man who understood from his first day in America that the only security available to him was the security he built himself. The purchase changes everything. The rent that had been leaving his business every month now stays in it. The location that had been vulnerable to a landlord's decision is now his. The building itself appreciates over time, creating wealth passively while the laundry continues operating. And when Wei eventually retires, he has 2 assets to pass to his children, the business and the building, rather than one business that exists only as long as a landlord permits it. Every method on this list funnels toward this outcome. The rotating credit circle builds the down payment. The ethnic trade monopoly builds the cash flow. The informal loan system provides the bridge financing. The mutual aid society provides the guarantee. The education of the next generation ensures someone in the family can navigate the legal system that governs the transaction. These were not 21 separate tricks. They were one integrated system built by communities that had been excluded from the American financial system and that responded by building a better one. America said no. They found another door and then they bought the building it was in. If you enjoyed this video, subscribe. Watch the next video above.